Welcome to the GCV Weekly Briefing Podcast, where we break down the key financial and economic developments shaping the landscape for investors, businesses, and policymakers. This week, we'll be diving into four major stories, from the surge in UK government bond yields to a record low overseas investment in the UK property market, to Universal's ambitious theme park project in Bedfordshire, and the latest India-UK trade talks. There's a lot to unpack, so let's get started. We start this week with a sharp rise in UK government bond yields. On April 9th, UK 30-year gilt yields hit 5.5%, the highest level since 1998. This was in response to rising trade tensions, particularly around President Trump's new tariffs on imports, which sent shockwaves through global bond markets. As a result, investors are rethinking central bank policy. UK interest rate futures are now pricing in 2 Bank of England rate cuts in 2025, with a 68% chance of a first reduction as early as May. But even as these rate cuts are expected, the bond sell-off has pushed up long-term borrowing costs, making fiscal planning more challenging for the UK government. The Bank of England has warned that the UK's openness to global capital flows makes it particularly vulnerable to external financial shocks. This raises concerns, especially as the government faces growing demand for infrastructure spending. According to Lizzie Galbraith, a political economist at ABRDN, the UK is stuck between its own rate-cutting path and global markets pricing in more volatility. Next, we turn to the UK property market, where overseas buyers now account for just 1% of property purchases in the UK as of Q1 2025. This is the lowest share since records began in 2005. In central London, the drop is even more pronounced, with international buyers now making up only 2.9% of the market, down from a peak of 7.9% in 2009. This shift seems largely due to changes in tax policy, such as Labour's proposed overhaul of non-domiciled tax status. In addition, European interest in the market has plummeted, now making up just 43% of overseas buyers, the lowest interest since the global financial crisis. By contrast, buyers from North America and the Middle East are showing increased interest in the UK property scene. The shares of US buyers has risen to 16%, more than double its 2008 level. Analysts point to currency advantages and long-term investment strategies as key factors shift. Tom Bill, head of UK residential research at Knight Frank, said we've never seen the international mix change this quickly. London is still a global city, but buyers are different now, and they're coming for different reasons. For UK-based investors, this could mean new opportunities, especially in prime locations once dominated by global capital. Now for some exciting news in the world of infrastructure and investment. Comcast has confirmed plans to build a new Universal Studios theme park in Europe, right here in the UK. This £50 billion project is set to open by 2031 in Bedfordshire and will create more than 28,000 jobs, including 20,000 during construction and 8,000 permanent roles. The park will be built on a 476-acre site, offering direct rail links to London and Luton Airport. Universal's vision goes beyond just a theme park. The development will include a hotel, dining and retail spaces, and a dedicated creative studio area. The entire project is expected to bring in £50 billion to the UK economy by 2055. Paige Thompson, Universal's EVP for International Destinations, described the project as more than a theme park. It's a transformative project that will support tourism, jobs, and growth for generations. The timing and the scale of this investment coincide with the UK's broader push to attract foreign direct investment into the creative industries and regenerate areas outside of London. This is definitely one to watch as it unfolds. Finally, we turn to a significant development on the international trade front. After 14 rounds of negotiation, the UK and India are very close to finalising a free trade agreement, with around 90% of the deal already settled. Key issues that remain include tariffs on whiskey and access to British pharmaceutical firms. A breakthrough has been made on mobility, with plans to create smoother visa routes for Indian professionals entering the UK. If the deal is finished, it could have a major impact on both countries. For instance, India's 150% tariff on Scotch whisky could be reduced, and UK businesses could gain better access to India's growing middle-class consumer base. The trade deal is also seen as central to the UK's post-Brexit strategy, especially with recent tensions between the US and the EU. A senior UK trade negotiator involved in the process said that the negotiations are in the endgame now. What's left is political choreography. Both sides want to win, but neither wants to blink first. As we've seen today, there's a lot happening, particularly in the UK. From rising bond yields to changes in international investment patterns and transformative infrastructure projects, the UK is at a crossroads of several economic shifts. At the same time, we'd be remiss not to mention the dramatic developments across the Atlantic, where the US stock markets have just experienced one of their biggest rallies since World War II, driven by President Trump suspending tariffs on most nations. It's clear that global environments remain volatile, with uncertainty continuing to shape markets and policy decisions alike. Looking ahead, we'll keep an eye on effects of these shifts, especially with regards to ongoing developments in UK-India trade negotiations, as well as the implications of the bond yield surge on UK fiscal policy and, of course, the changing landscape due to the US's position on tariffs. Stay tuned for next week's briefing, and we'll include some more insights into these evolving trends.